Employees are the key to the success of every organization. Therefore, every employee deserves to be compensated for making the organization successful in the competitive market. The sweat equity shares and employee stock ownership plans, or ESOP, are the best way to compensate them, improve employees' morale, and retain them for the long term. Before moving ahead, welcome to Upstep Financial, and for this video we'll be talking about the purpose of ESOP versus sweat equity shares, and their importance. But before that, make sure to subscribe to our channel and turn on the notification bell so you will get updated on our future uploads. It would also be nice to give this video a like and share it with your friends. First, we will understand what sweat equity and ESOPs are. Then we will talk about their differences. Let's start with the meaning of sweat equity shares. Sweat equity shares mean value shares issued by a company to its representatives or directors at a discount or for consideration, other than cash, for giving know-how or making available rights like intellectual property rights or value increments. The Companies Act governs sweat equity shares, and they are subjected to many conditions. Sweat equity shares are issued by passing a particular resolution form, with agreement and votes by 2/3 of shareholders. Following the issue of shares, they will be non-transferable for a 3-year period. After that, the cost at which the sweat equity shares and the valuation of intellectual property rights or know-how or value increases for which the sweat equity shares are to be issued will be valued by an enrolled value. And now, employee stock option plans, or ESOP. The term employee stock option plan has been defined under subsection 37 of section 2 of the Companies Act, according to which employee stock option means the option given to the directors, officers, or employees of a company, or its holding company or subsidiary company or companies, if any, which gives such directors, officers, or employees the right to purchase or subscribe for the company's shares at a future date at a predetermined price. Section 62 provides that a company may issue further shares to its employees under a scheme of employee stock options, subject to a special resolution passed by the company and subject to such conditions as may be prescribed. Rule 12 of Companies' Share Capital and Debentures Rules concerning the issue of employee stock options covers the issue of ESOPs. Let's discuss the significant differences between an ESOP scheme and the issue of sweat equity shares one by one. Number 1. Allotment. ESOP is a grant of options to workers to buy shares in the future at a set cost. The shares are allotted to the representatives only after the workout of the ESOP grant. On the other hand, sweat equity is the coordinated allotment of shares at a discount or consideration other than cash. Number 2. Timelines are important. A company can issue sweat equity only after precisely 1 year from the date of commencing trade. However, there's no such limitation on the issue of ESOPs. They can be issued at any time. Number 3. Cliff and lock-in. For ESOPs, there's at least a period of 1 year between the grant and vesting of choices. For sweat equity, there's a lock-in period of 3 years. In contrast, there's no obligatory lock-in period for the allotment of equity shares under the ESOP. For ESOPs, the company should have the flexibility to specify the lock-in period of the shares issued, agreeing to the exercise of stock options. What have you learned from this video? Let us know. Please give us a like and don't forget to subscribe to Upstep Financial and type your insights in the comments section as you're watching this video. Number 4. Who qualifies? The definition of employee is diverse for ESOPs and sweat equity shares. Sweat equity can be issued to a permanent employee of the company who has been working in the company for at least the last year. No such limitation for the issue of ESOPs. ESOPs cannot be issued to a free executive. In contrast, sweat equity can be issued to an autonomous director. ESOPs cannot be issued to the individual belonging to the promoter group, promoters, or to a director who either himself or through his corporation or relative, directly or indirectly, grab more than 10% of the outstanding equity shares of the company. The only particular case is usually for founders or promoters of the DPIIT, or Department for Promotion of Industry and Internal Trade, recognizing new companies where they are qualified to get ESOPs for up to 10 years from the date of joining. This limitation does not apply to the issue of sweat equity. Number 5. Dilution. The company cannot issue sweat equity for more than 15% of the existing paid-up equity share capital in a year, or shares of the issue value of $50 million, whichever is higher. Moreover, the issuance of sweat equity within the company cannot surpass 25% of the paid-up equity capital of the company at any time. However, in the case of a startup, the issuance of sweat equity shares cannot surpass 50% of its paid-up capital, up to 5 years from the date of its joining or enrollment. These confinements don't apply to the issue of equity shares under the ESOP plot. Number 6. Exercise. For ESOPs, companies have the opportunity to decide the exercise cost contradiction with the applicable accounting policies. For sweat equity, an enrolled value will decide the share's reasonable cost and legitimize such evaluation. Consideration for the purchase of shares under the ESOP plot can be done only in cash. However, a company can issue sweat equity offers to its representatives at a discount or consideration other than cash. Although there's a difference between sweat value shares and ESOP, both are two types of acts that a company can use to communicate that representatives are valued and recognized. These types of schemes assist companies in retaining valuable employees for an extended period and benefit from their efforts to improve the company's performance. However, both sweat equity shares and ESOP cannot be conducted through a preferential share allotment. A company can issue its shares to the employees. This gives a motivation for the employees to contribute better to the company and propel them. It also helps to hold the employees in the company for the long term. Employee Stock Option Plan, or ESOP, and sweat equity shares are two strategies for issuing shares by a company to its employees. First, however, the recorded companies need to comply with the Securities Exchange Board of regulations or guidelines for issuing these shares. We are at the end of the video. Please leave us a like. You can also comment below your thoughts about ESOP and sweat equity shares. We always appreciate your insights. Don't forget to subscribe to this channel and turn on the notification bell so you'll get updated for our future uploads. Once again, this is Upstep Financial. Thanks for watching. Cheers.